All right, let's jump right into this explainer. We're picking up right where we left off in Section 05. You just saw how the operational payroll run actually works. But here's the thing. You've run the payroll, the money went out, but the job is far from done. We have to translate that physical operation into the general ledger, and we have to secure the company's compliance before the whole cycle resets and starts all over again.
So this is where we are on the map. We are sitting squarely at step 2. We are taking the physical act of paying people and building the necessary financial and legal architecture around it, right before we move on to step 3.
We're looking at 4 main pillars today: translating payroll to the GL, authorizing mid-cycle changes, records retention and audit defense, and separation and annual compliance. Let's get to it. Pillar 1. Translating payroll to the GL, specifically the 11 accounting entries.
Okay, so there are exactly 11 accounting entries for this cycle, and they're split into 2 very different camps. Let's start with the 9 employee entries. You've got your gross salary expense and your Section 125 pre-tax deductions. Then the third one is huge, employee tax withholdings. Remember, these funds are literally held in trust. They are never, ever the employer's money. Then you have the employer payroll tax expense, the actual net salary payment going out the door, employer benefit contributions, workers' comp premium accruals, and PTO accruals. Finally, you have remittance entries that clear all those payables out. It's a lot of moving parts. Now contrast that web of 9 employee entries with contractors. For contractors, it is just 2 simple entries. First, a contractor expense routed directly through accounts payable. Second, the payment disbursement. That's it. Notice what's missing there? There are absolutely no tax liabilities, no FICA, no FUTA, and 0 withholding payables.
And this right here perfectly illustrates the danger of what we call the commingling sin. Picture this. Your controller is doing a routine review in January, and they suddenly realize a contractor payment has been sitting in a payroll GL account for the last 6 months. Yikes! Because employee entries naturally carry FICA obligations and benefit accruals, mixing a basic AP expense into that bucket is a massive audit red flag. To an auditor, it looks like a major worker classification failure, or at best, a total breakdown in internal controls.
Moving on to Pillar 2, authorizing mid-cycle changes and the requirements for updates.
If you take one thing away from this entire section, make it this. Verbal has absolutely no standing. None. 0. Whether we're talking about a pay bump, a new benefits package, or a contractor changing their scope of work, if it's only a verbal agreement, it literally does not exist in this cycle. So for your employees, every single change needs a written, signed HR change authorization form with sign-offs from both the manager and finance. And timing is everything. Did someone move to a new state? You have to action that before the next payroll run so you can set up the new state withholding and unemployment accounts. Reclassifying someone's FLSA overtime status? You better have a documented business reason. W-4 updates and qualifying life events have strict 30 to 60-day windows. And for leaves of absence, HR has to designate FMLA and state leaves to run concurrently, updating payroll right alongside it.
And for contractors, same golden rule. Verbal has no standing. You need a signed statement of work amendment for any scope, fee, or timeline shifts. Plus, there are 2 massive triggers you have to watch out for that require an immediate classification reassessment. First, if the contractor's role starts looking like regular employment, like they're managing people or working set hours. Second, if the engagement extends way beyond the original timeline. The IRS and the DOL look at long-term arrangements as strong indicators that this person is actually an employee.
All right, Pillar 3, records retention and audit defense, your company's armor. A lot of people view record retention as just annoying paperwork. It's not. This is your company's absolute armor during an audit. You can't just hit delete to clear out your hard drive. I-9s, payroll records, and W-4s, those stick around for 3 to 4 years. Employment records are usually 3 to 7 years depending on the state, and ERISA plan records are 6 years. Now, look at contractors. Statements of work and invoices must be kept for 7 years to cover the IRS audit window, and W-9s are kept for 4 years after the final payment. But here is where it gets incredibly serious. See that line about retaining classification memos indefinitely? That's not a typo. While normal IRS audits look back 3 to 6 years, auditors have 0 statute of limitations when it comes to alleged fraud or willful neglect on worker misclassification. Because they can look back forever, this memo is literally your only proof that you did a good faith analysis. Do not ever destroy it.
Finally, Pillar 4,
separation, and annual compliance. The price of failure.
When an employee leaves, HR has to alert payroll, IT, finance, and benefits immediately. Why the rush? Because missing a final pay deadline is brutally expensive. States like California and Colorado demand same-day final pay for involuntary terminations. If you're late in California, you are penalized 1 full day of wages for every single day you're late, up to 30 days. Also, states like California, Colorado, and Massachusetts require accrued PTO to be paid out in cash. On the benefits side, health coverage ends per the plan rules, 401k options get communicated, and remember, HSAs are fully portable, that money belongs to the employee.
Then there's COBRA. If you have 20 or more employees, you have exactly 14 days from the qualifying event to issue that COBRA election notice. Miss that 14-day window? The penalty is $110 per beneficiary per day, and it just quietly accumulates?
Let's put that into perspective. Say you terminate an employee who has a spouse and 2 kids. That's a family of 4. If someone forgets to send that COBRA notice and you don't catch it for 90 days, you are looking at a $39,600 penalty. And that is before a single medical claim has even been filed. The stakes here are just staggering.
Closing out the year, you've got a very strict annual filing calendar. January 31st is the massive deadline for W-2s, 1099 NECs, Form 940, and 1095Cs. Throughout the year, you're tackling OSHA postings, ERISA 5500 filings, and workers' comp audits. But don't gloss over that last one, the annual contractor classification review. It is not optional. If a contractor gets reclassified as an employee down the line, all of their historical hours count toward the Affordable Care Act full-time equivalency, which can create a massive retroactive ACA exposure for the company.
So, we've covered a lot. We've mapped out the GL entries, the strict rules for authorization, why you need to hoard those records, and the steep penalties for getting separation wrong. Which leaves us with one incredibly important question. What happens structurally when the internal control architecture holding all these moving parts together actually fails? Well, that's exactly what we're going to uncover in our next explainer. See you there!